Justin, Trump floats a 50-year mortgage, and Bill Pulte confirms the FHA is working on making it happen. Will it fix the housing crisis or make it worse? And what effect will it have on the bond market? So, some interesting implications with bond math that you probably won't find on other channels later on in the video. But important context here: Americans are paying banks $280 billion in credit card interest every single year. The K-shaped economy is largely those that own assets and benefit from higher rates versus those that are paying the higher rates, as we can see there. If you total up the total amount of personal interest payments, it's $571 billion per year. Per person, that works out to $3.3 thousand per person in the labor force. And if you divide that by the average hourly wage, it equates to about 106 hours that the average American is working just to pay the interest on their debt. Not only that, but as we can see, banks are charging ever higher spreads above and beyond the 10-year Treasury yield benchmark. We can see back in the 90s, 2000s, credit card interest rates were about 9% higher than the 10-year Treasury yield. And as we can see, that has doubled to 18%. So banks are just absolutely raking it in. Again, important context for this proposal, as we will see in a second. This is a huge part of the problem. So for the housing market in particular, we have had home prices go up and interest rates go up, and both have remained sticky. As we can see, that has caused the average annual interest on the average home, assuming a 10% down payment, to go from about $11,000 to $28,000. And that is due to the fact that you have a rise in mortgage rates and you have a rise in home prices, and those both of which have remained sticky and not come down. So here we're looking at consumer credit growth versus real GDP. Remember, private banks print the vast majority of dollars in the system. When a private bank goes to extend a loan, they are printing money, and 90% of the dollars in the financial system were printed by a private bank when they extended a loan. Well, it's no surprise that real GDP correlates quite strongly to that rate of change of consumer credit growth. Applying that to the housing market, down below, we can see mortgage debt, the growth rate of mortgage debt relative to the growth rate of home prices. Well, if a bunch of new buyers are going out to banks because now they can afford a lower monthly payment on a house, and they go to banks to get more money to buy the homes, if the banks are extending more credit, more debt, more mortgage debt, that should equate to a rise in the price. So this is going to just cause home prices to go up because banks are going to be extending more loans. Well, that means there's more money out there in the system that can chase a scarce amount of homes. And of course, this is doing nothing to address what some argue is a scarcity or shortage of housing units. Personally, I don't see the evidence for that. I think that there are other much more important drivers. Here we're looking at the average sales price of a single family home and the average mortgage size. We can see average mortgage size has actually come down despite the fact that home prices are going up. This indicates cash buyers are stepping in to a degree we have never seen in recorded history. So the average home price multiplied by how many homes are sold, we can see that the real estate market equates to $2 trillion. So this is critical in terms of the US economy in aggregate. So this is a massively underappreciated dynamic causing the housing crisis. We are running a $1 trillion per year current account deficit. Mainly, this is comprised of the balance of trade, our very, very large trade deficit. It equates to about $1 trillion per year, as we can see there. Well, remember, the way we pay for that on a balance of payments basis is the mirror image of that. Here, we're looking at $1 trillion capital and financial account surplus. So the way that we pay for all those cheap goods is by selling financial assets to foreigners. And again, on a balance of payments basis, it must net out to zero. So $1 trillion trade or current account deficit, that equates to $1 trillion per year guaranteed bid into financial assets. Well, I did the math from the BEA and found that in 2023, the total amount of real estate inflows equated to about 180,000 single family homes. So this is a massively, massively large issue that needs to be addressed. It's not being addressed by this proposal. The fact that we are running these very, very large trade deficits, therefore requiring ever larger amounts of capital to flow into our financial assets. That is how we finance, one of the ways we finance our current account deficit. Of course, being the reserve currency issuer of the world, that is how we must get dollars out to the rest of the world, is by running a very large current account deficit. That is Triffin's dilemma. The other problem that this proposal does nothing to fix, here we can see the Fed holds 10% of total amount of mortgages out there in the US. That equates to about 15% of residential mortgages, as we can see, $2 trillion. Now remember, when the Fed buys these mortgage backs, these bonds, they are printing money out of thin air to buy the bond. When they buy the bond with freshly printed dollars, that pushes the bond price up and the interest rate down. As we can see back here in the early 2000s, the Fed held zero mortgage-backed securities. Well, they now hold $2 trillion. And so what they are doing is subsidizing the risk. They are coming in, printing dollars, pushing the bond price up, the mortgage-backed bond price up, therefore pushing the interest rate artificially low. Now, this gets into some of that interesting bond math. So here we see the premium of a 30-year mortgage above and beyond whatever the 10-year treasury yield is. Right now, that spread is 2.1%. Look at the correlation that it has to the MOVE index, which is U.S. Treasury bond market volatility. As bond market volatility goes up, so too does the spread, the premium that you are paying in terms of higher interest rate on a 30-year mortgage relative to a 10-year treasury yield. That is critical for this slide that we're getting into here, which goes over duration. So here we're looking at a couple different instruments of different durations: 2-year, a 4 to 7-year mortgage back, and a 30-year. Now, you might think a mortgage-backed security has a duration of 30 years, but it actually doesn't, due to prepayment and refinancing, as we will see in a second. And then, of course, 30-year treasury futures. What we can see is that the longer the duration is, the more volatility you are exposed to as a bond investor. Now, this will come into play here. Here, we're going to look at convexity. So this is one of the issues with this 50-year proposal. Convexity describes the relationship between the price and the yield. Usually, bonds have positive convexity. The price of the bond rises more when rates come down, but falls less when rates rise. However, mortgages introduce what is known as negative convexity due to prepayment risk. Think about it. When rates come down, borrowers, the average American with the mortgage, goes and refinances their mortgage. Well, that shortens the mortgage life, or the duration of the loan, and therefore caps the price up, the upside, the amount of price upside that you could get with the mortgage-backed security. Therefore, prices don't rise as much as you would expect. However, when rates rise, prepayments slow down and effectively extend the duration, and therefore amplify the downside losses. So with a 50-year mortgage, investors might demand higher yields, a wider spread over, say, a 10-year treasury yield, to compensate for that increased negative convexity. As we can see, just the difference between a 30-year bond and a 4 to 7-year bond, as we can see, 11% versus 25%. So the longer the duration of the debt instrument, especially with mortgage backs, which have negative convexity, you are going to demand ever higher premiums. Now, remember that number, 0.5 to 1% premium above and beyond the 30-year treasury yield. Remember that, because that will become very important. Now, here is a AI. I asked AI to compare a 1% rate increase on a 30-year versus a 50-year relative to a 1% rate decrease, so that you can see that convexity there. Kantro. So Kantro pointed out that the math doesn't work with a 100 basis point spread. With a 1% premium for the 50-year relative to the 30-year, the math doesn't actually math out. So what this means is the federal government is going to have to come in and backstop, or guarantee, or buy even these mortgage backs, because again, from what I was able to gather from research put out already looking at a 50-year mortgage back proposal, that premium, again, due to that negative convexity, the increased duration risk, is going to be about 1%. Well, the math doesn't work on 1% increase. So here shows the amortization. This is absolutely brutal. You are not making any payment on your principal until like you're 25 or 30. It's just absolutely brutal compared to a 30-year mortgage, as we can see there. Someone put a reply to me, we want affordable housing, and Trump said the best I can do is an additional 350,000 in interest payments. It is actually even worse than that. So here is a 30-year mortgage on the average home price, $510,000. We can see over the lifetime of the loan, you will pay $617,000 in interest over that 30-year mortgage. Well, if we look at a 50-year mortgage, you're going to pay $1.1 million in interest. That is nearly double the amount of interest on a 30-year mortgage versus a 50-year mortgage. Again, assuming the average home price, which is $510,000. We established earlier, this is going to spur demand. A bunch of people that can't afford to buy a house on a 30-year, that lower monthly payment is going to spur demand. Well, as private banks extend more loans, more mortgages, that means more dollars are being printed to buy houses. Housing is a relatively scarce asset, more dollars, relative constant supply. And what do you get? You get even higher prices. So this proposal is pretty much an unmitigated disaster. As we can see, again, is doing nothing to address the fact that the current account deficit results in $1 trillion per year mandated inflow into capital and financial account, those financial assets. It does nothing to fix that. It does nothing to fix the fact that it's going to spur demand and actually make things worse by pushing prices up. It is doing nothing to address the fact that higher interest rates are a direct result of ever larger government deficits, 7% of GDP. It does nothing to bring interest rates down, which is what would help massively in terms of housing affordability. It also does nothing to address the fact that banks are increasing their spread. They are charging ever higher amounts of interest above and beyond the 10-year treasury yield. And again, every time personal per capita interest payments, every time it reached 100 to 110 hours, we had a recession shortly thereafter. The average American is working 106 hours of work every single year just to pay the interest on their debt as it is. And we established what this would do. You would pay $1.1 million in interest to a bank over a 50-year mortgage than you would over a 30-year mortgage. So it is just absolutely insane that we've gotten to this point. I'm going to link two reports that I think are very interesting. This is just absolutely great report. Summarizes my thoughts pretty well if you want to read. This is basically 100% I agree with this report and the findings of this report. I'm also going to link this report that talks about bond market volatility with mortgage-backed, and I'm a nerd, so I thought that this was interesting. If you're a nerd, you will probably find it interesting as well. But again, remember that negative convexity as a result of that increased duration. There is going to be a higher amount of premium, a higher spread above and beyond the 30-year treasury yield or the 30-year mortgage yield. And therefore, as Kantro pointed out, the math doesn't actually even work if the yield curve is 100 basis points steeper than it is. 100 basis points is not very much in terms of a yield curve steepening between the 30-year and the 50-year, given kind of the general macro backdrop that we find ourselves in. So it's really doing nothing to address any of the actual causes of the problem. Increased bond market volatility here, we can see direct result of increased mortgage rates over and above the premium, over and above the 10-year treasury yield. Does nothing to address the fact the Fed holds 15%, $2 trillion of mortgage-backed securities. Does nothing to address the fact that we are running $1 trillion per year current account deficit, trade deficit. It does nothing to address the fact, actually just makes it worse, that it is going to increase credit growth and therefore increase the home prices, because home prices are relatively scarce as dollars are printed to chase more housing, running in a run it hot sort of environment. Of course, that's going to push prices up. And it does nothing to address the fact that interest rates are higher as a direct result of bad government policy, of 7% pro-cyclical government deficits. Just absolutely insane. So anyways, hopefully that was helpful. I do not think that this is a good idea. I think it'll make things exponentially worse. But anyways, hopefully that was helpful, and I will catch you in the next one.